Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LIANLIAN Digitech Co. Limited annual report. LIANLIAN Digitech Co. Limited offers a diverse range of businesses and services to its clients globally. The company's primary focus lies in digital payment services, which include pay-in, pay-out, acquiring, foreign exchange, virtual card, and payment aggregation services. In addition to these core services, LIANLIAN Digitech also provides value-added services such as business and technology services, property leasing and management, digital marketing, referral, account and e-wallet, software development, and information technology services. These services cater to the needs of small and mid-sized merchants and enterprises in China and internationally. The company's comprehensive service portfolio enables it to support its clients' various requirements, from financial transactions to business operations and technological solutions. With a strong presence in Hangzhou, China, LIANLIAN Digitech Co. Limited has established itself as a reliable provider of digital payment services and value-added solutions. LIANLIAN Digitech Co. Limited maintains a market capitalization of $6 billion, broadly in line with the industry peer group. LIANLIAN Digitech Co. Limited trades at a lower price-to-earnings ratio of 3 times and a higher price-to-book ratio of 2.18 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The company exhibits a very high leverage profile, with liabilities accounting for 92% of total assets. This elevated debt level warrants heightened caution, as it may limit the company financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the key factors that have impacted a company's financial performance. On the positive side, digital payment services have been a significant contributor to revenue growth, with a notable increase in both global and domestic payment segments. Additionally, value-added services have also seen substantial growth, although this trend was reversed in 2025, resulting in a decline of 13.6%. Other drivers of revenue growth include employee benefits, processing fees to financial institutions and payment networks, and service charges. In contrast, the primary driver of revenue decline is the value-added services segment, which saw a significant drop in revenue from RMB 146,193 in 2024 to RMB 264,886 in 2025. This decline was not offset by growth in other areas, resulting in a net decrease in revenue for this segment. Overall, the company's revenue performance has been influenced by these key drivers, highlighting the importance of digital payment services and value-added services in driving growth, as well as the need to address declining trends in certain segments. The financial performance of the company has undergone significant changes in recent times. A notable increase in net income is observed, with a growth rate of 28%. This upward trend indicates a substantial improvement in the company's bottom line. However, a closer examination reveals that profit margins have not followed suit. Specifically, the gross profit margin has decreased by 1.5 percentage points to 50.4%. The primary reason for this decline is attributed to the lower gross profit margin from the virtual card business. This suggests that while the company's overall revenue may be increasing, its ability to maintain profitability in certain segments is being compromised. The company's financial performance indicates a significant improvement in its ability to generate cash. According to the latest figures, the net cash generated from operating activities has increased substantially. In fact, the company is now generating positive operating cash flow, which is a crucial indicator of its financial health. This achievement can be attributed to various factors, including improved operational efficiency and effective management of resources. The increase in operating cash flow suggests that the company's business model is becoming more profitable, enabling it to generate sufficient funds to meet its financial obligations. As a result, investors and stakeholders can have confidence in the company's ability to sustain its growth trajectory. The positive operating cash flow also provides the company with the necessary liquidity to invest in new opportunities, repay debts, and reward shareholders through dividends or share buybacks. Overall, this development is a testament to the company's financial resilience and its capacity to navigate challenging market conditions. The company's debt level has undergone significant changes over the period. Initially, the total debt stood at RMB 164,052, but it decreased to RMB 138,312, indicating a reduction of RMB 25,740. This decrease is further emphasized by the fact that borrowings dropped by 93% and non-current liabilities reduced by 69.3%. However, bank borrowings pledged saw a slight increase of 8.1%. In terms of interest expenses, there was no specific figure provided for page 4. Nevertheless, it is clear that interest expenses decreased due to the repayment of bank loans. Furthermore, both long-term and short-term interest expenses were reduced as a result of lower interest rates. These changes collectively indicate a decrease in the company's debt level and interest expenses over the period. Management is projecting a positive outlook for the company, driven by its strategic priorities. The key focus areas include consolidating competitive advantages in cross-border payment and compliant financial services, expanding globally into emerging markets, and driving technology-led transformation through AI investments. This will enable the company to upgrade business products, improve operational efficiency, and enhance user experience. The company plans to pivot resources towards high-value opportunities created by the globalization of Chinese enterprises, with technology, particularly AI, being a core strategic priority for delivering value to customers. To achieve this, management aims to expand customer acquisition and industry coverage, increase investment in promotional activities, and advance AI-enabled efficiency improvements. In terms of financials, the company is expected to benefit from increased return on funds and decreased interest expenses, resulting in sufficient liquidity and control over internal operating cash flow. This positive outlook underscores management's confidence in the company's ability to execute its strategy and drive growth. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries. This suggests a stable and focused approach to its operations, with no major changes to its portfolio or structure. As a result, the company's overall strategy and direction remain unchanged. The company's financial activities have been focused on share buybacks rather than dividend payments. According to the provided information, a significant amount of cash was utilized for the repurchase of outstanding shares, totaling RMB 109.9 million. This indicates that the company has prioritized returning value to its shareholders through share buybacks over distributing dividends. That concludes the financial summary for LIANLIAN Digitech Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.